Most crypto projects lower fees to attract more users and make more money. Ethereum is doing the opposite. It's the only major chain deliberately making its own layer cheaper, even when that means less revenue for itself. $148.8 billion in stablecoins settle on Ethereum. $17.2 billion in tokenized real-world assets sit on it. JP Morgan and Fidelity are both putting financial products on this chain. Q2, 2026, apps built on Ethereum made $1.79 billion in fees, but daily mainnet revenue just dropped to $330,000. Not $330 million, $330,000. The Ethereum burn that was supposed to make the asset deflationary fell from thousands of Ethereum a day to somewhere between 50 and 70. Ethereum didn't get here because people left. It got here by shipping upgrades that push activity off its own layer on purpose. So the real question isn't what happened to the revenue, it's why Ethereum keeps choosing to lower it. The most recent of those choices was Fusaka. On December 3rd, 2025, Ethereum activated the Fusaka upgrade. The main feature was something called PeerDAS. Here's the simple version. Layer 2s like Arbitrum, Base, and Optimism take a bunch of transactions, pack them into data packages, and post those packages to Ethereum. That's how they borrow Ethereum's security. Before Fusaka, every node on the network had to download the entire package to check it. That was slow and expensive, so there was a hard limit on how much data could be posted. PeerDAS changed that. Now each node only checks a random sample of the data and mathematically confirms the rest is there. Same security, way more capacity. Then Ethereum made two small follow-up changes, one in December 2025, one in January 2026. Together, they raised total data capacity by about 8 times compared to before Fusaka. Layer 2 fees dropped again. The fees Ethereum used to collect from those data packages fell close to zero. Ethereum completely solved the data cost problem for Layer 2s, and in the process, cut another channel of its own revenue. At this point, you can start to see what Ethereum is actually optimizing for. And in February 2026, Vitalik said out loud what that strategy was building toward and what needed to change. For years, Ethereum's official plan was simple. The Ethereum layer wouldn't try to handle more transactions. Layer 2s would do all the heavy lifting. The Ethereum layer would just provide security and data space. In February 2026, Vitalik said that plan no longer makes sense. Two things broke it. First, Layer 2s decentralized much slower than expected. By 2025, only 3, Arbitrum, OP mainnet, and Base had reached a meaningful level of decentralization. Most of the rest are still controlled by their own teams. Those teams can still pause the chain, upgrade it, or block transactions. They call them Layer 2s, but most of them operate more like independent chains run by their own companies. The original plan assumed trustless Layer 2s would show up quickly. They didn't. Second, the Ethereum layer itself started scaling better than expected. Fees stayed low. Gas limits went up. The core assumption that the Ethereum layer couldn't handle more turned out to be weaker than people thought. So, Vitalik started pointing toward something different, not just faster throughput, but Ethereum evolving into something with real differentiated value, security that can't be faked, privacy that actually works, infrastructure that doesn't need a team of operators to keep it honest. So what does that actually look like? You'll see it in what comes next. In 2025, the Ethereum Foundation laid off 19 people. In 2026, it cut another 54, about 20% of its staff. More than 9 senior people left in 2026 alone. One entire research team focused on privacy and scaling was shut down. In March 2026, the Foundation published a 38-page document called the EF Mandate. The central point, the Ethereum Foundation is not the center of Ethereum. It's one steward among many. Its job is not to lead the network. Its job is to protect the properties that make the network worth running. Those properties have a name: crops, censorship resistance, capture resistance, open, private, secure. Every decision is now checked against whether it helps or hurts those 5 things. Take the staff cuts and these 5 properties together. Ethereum is moving toward financial infrastructure that can operate with as few managers as possible, where the properties themselves do the work, not a central team. Let's keep tabs on where Ethereum's at right now. Right now, every Ethereum transaction is public. Your address, your balance, your full history, visible to anyone, forever. For a network trying to settle institutional money at scale, that's a real problem. Privacy isn't a nice extra, it's a requirement. That's why the foundation launched the Kohaku initiative and released the Kohaku SDK in May 2026. It lets any wallet add privacy features directly, so users don't have to understand the complicated parts. Hagota, the next upgrade, will push those tools even deeper into the protocol itself. But all of this runs into one growing problem: the state. Every node running Ethereum has to store the full current picture of the network, every balance, every contract, every token holding. It grows by about 100 gigabytes a year. The more Ethereum succeeds, the heavier it becomes to run a node. In July 2026, Vitalik published Lean Ethereum. He called it the biggest rebuild since the merge. The idea is simple. Every block includes a mathematical proof, so anyone can verify it without trusting validators. It's also built to resist future quantum attacks, with privacy turned on by default. The bigger goal is simple: infrastructure that can run securely at global scale, without relying on a small group of people to keep it honest. How can we tell these are the real priorities? Look at EIP 8363, Tapered Issuance Burn. 6 authors, including one of Ethereum's most well-known researchers, Justin Drake. Simple to explain and hard to accept if you're staking Ethereum. Here's how issuance works today. Every block, the protocol creates new Ethereum to pay validators for securing the network. The more Ethereum that's staked, the more new Ethereum gets created in total. Right now, about 33% of all Ethereum is staked, and validators earn roughly 2.6% a year. EIP 8363 would burn a rising share of those validator rewards as more Ethereum gets staked. At today's staking level, yields would drop from 2.6% to about 1.2%. If staking ever reaches 50% of all Ethereum, the yield goes to zero. The reaction was fast and negative. Aave's founder called it one of the most resisted proposals in Ethereum's history. The founders of 2 major staking businesses ran public campaigns against it. Critics say cutting rewards could discourage staking, which might end up concentrating power even more among the large players who can absorb the lower yield. EIP 8363 didn't make it into Hagata. It's still a draft, but the authors haven't pulled it. So why is Ethereum's core research team pushing a proposal that makes staking less attractive against strong community resistance? What goal is worth the fight? In the Ethereum Foundation's March 2026 mandate, they described what the Ethereum layer should become. We were Ethereum's first steward. Now we are one of many. And when we are gone, we hope the principles here will continue on without us. What we have often called the infinite garden, a growing ecosystem of people, projects, communities, and institutions working to keep systems open, private, resilient, humane, and free.
What the hell are you talking about?
For years, the Foundation, Vitalik, and core researchers have used different words for the same idea. World computer, neutral global layer, infinite garden, backbone of the on-chain economy. The common thread is always the same: an infrastructure platform anyone can safely rely on. Decentralized, tamper-resistant, and running through automatic mechanisms, not human discretion. EIP 8363 makes sense through this lens. If staking concentrates in a few large operators, that's a capture risk. Cutting rewards at high staking levels reduces the incentive for large players to keep accumulating control. And that points to a much bigger goal. Ethereum wants to make sure that no small group of operators can become powerful enough to control the network. They're building toward a system that no one can control, a system that can run and govern itself without relying on human decision makers. That's it for today's video. Investing is the lens to see the future. This was Alt Narrator. Catch you next time.